so this is kind of part 2 to the do not diversify video, why diversifying is a scam. Now we're going to explain the solution, how you actually control, or one of the ways you can actually control your risk, which is size. The size of your positions, the size of your position relative to the size of your account. So we can control each and every trade that we enter into with options and with stop losses. So before we get into options and make that complicated, just sticking with stocks, one of the most basic and most useful tools that you can have for controlling risk is a stop loss. This is basically a mechanism which tells the broker, tells the computer to sell this, whether I'm here at my computer looking at the screen or not, I'm working, I'm asleep, just sell this for me if it gets down to a certain level. That way you can always be protected against downturns in the economy and in the market. I don't know why anyone would not use a stop loss unless they just didn't know anything about it, totally new to trading like myself. I made this mistake, and just a really, really dumb novice mistake that can be completely avoided with like 5 minutes of education. So stop loss is just telling the computer to stop the loss at a certain point. A stock is $100, you tell it to sell at 95 so that the most you can lose is $5. And all the brokers can do this for you. Super easy, super simple to set up. I'll do a separate video about how to do a stop loss, but suffice it to say, that's how it's done. And we're going to look at some examples of how to use size with your stop losses to protect and protect you against and to control your risk. So we can go into the trade knowing how much risk we have beforehand. Let's have an account of $10,000, 10K, to start off our example. And I think we're going to do 3 examples. We'll do example A, B, and C. And in each one we're going to have 10K. So here's example A. If you had $10,000, how would you invest it in the stock market? Well, we could do a scenario where we have 2 stocks, stock A and stock B. If I were to take stock A and stock B and buy as much as I could of each one, and I'm going to go right down the middle, how much can I put in each stock if I have 10K? How much can I buy of A and B if I have 10K? Well, 5K and 5K. Okay, very simple. Now, a rule of thumb for myself in terms of risk, how much do I ever want to risk of my entire portfolio on any trades that I'm in? I always take the trades and total them up. I don't typically look at just one trade and the amount of risk. I look at my entire portfolio because that's the only thing that really affects me is the whole picture. I'm typically not willing to lose any more than 5% of my entire account on all of my trades combined, looking at it at a 1 or 2 month time frame, okay? It changes a little bit according to how hot the market is compared to how cold it is or how much bearish or how bullish it is. But for this example, 5%. That means that at any given time, if everything goes bad, which it can, how much would you be willing to lose of this 10K? 5%, that means $500. So when I go into these 2 trades of A and B, I don't want to lose more than $500 total. To make this simple, that means that I can't lose more than $250 on either of these stocks. So let's say that each stock is worth $100. You'll never have 2 stocks at exactly 100, but bear with me for the analogy. They're $100 a piece, okay? And you're going to put 5K, you're going to buy 5K of each, and they're both $100. How many stock would you get from stock A if you bought $5,000 worth at $100? Your answer should be 50. 50 times 100 is 5K. Okay? Same thing with stock B because they're the same exact price. So you bought 50 of A and 50 of B and you spent your entire $10,000. Okay, but we only want to have $500 of risk, or 5% of 10K, $250 for each trade. So how much, where would you set your stop loss at so that you only lose $250 on each trade? Well, look at the price of the stock and look at how many stock you have. And if you have 50 stocks and you can only lose $250, one of the easiest ways to do it is simply to divide your total loss by how many stocks you have. So if you have $250 loss and you have 50 stocks, that means that you can just do the math in your head. You should only be losing $5 per stock, and then that should be your stop loss. Because if you have 50 stocks and each one loses $5, that means that you've lost $250 total, and that's your max. Another way you could do this in your head is just 50 stocks, 250, that would be like $5 each. You do the math, and sure enough, if I lost $5 on 50 stocks, I'd lose $250. And if I did that for each stock, that means that the total I lose is $500. That's my max. So $5, okay? So what I want to go and do is tell my broker, if the stock is $100 right now, the most I can lose is $5 on each stock. You just minus it from the price of the stock. So $5 minus 100, okay? Minus 5 is $95. So I need to go into my broker and set a stop loss, tell my broker to sell my stock at $95 for each of these stocks. And if the market really does go down and I end up losing $5 on each stock, on A and B, I will lose a total of $500. If the stocks both go down to like $95.10, they won't sell. And then the stocks might shoot up and I get really lucky, I do really well, and I didn't get kicked out, and it let me stay in there. So this is one way where you could have your total loss, your total risk is controlled within these two stocks. That's example A. Example B would be if we were to do this with 4 stocks. So let's say you have A, B, C, and D. Now, instead of being able to put 5K in, we've got to divide this by 4 because we have 4 stocks now instead of 2. And what is 4 into 10K? Your answer should be 2.5K or 2,500, $2,500. 2.5K, 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 2.5K. Okay, so now we've again spent our $10,000. Now, if the stocks are all trading at $100, okay, they're all $100, then how many $100 stocks can you buy with $2,500? Your answer should be 25 bucks, because 25 times 100 is 2.5K. So we get 25, 25, 25, 25. And again, our risk, our overall risk of what we're willing to lose in this portfolio shouldn't change. It should never change just because you have more stocks or less stocks, or you're feeling greedy, or you're happy, or you're depressed. This should never change, okay? And it's always something that you know for yourself, because each trader will be different. Some traders will only want to risk 3%, some will risk 10%. That might change as you have more money. You'll be willing to lose less. It might get more as you make more money. It'll change for everybody, and we'll talk more about that later. Suffice it to say, we've got all our money spent, and we only want to risk the same, 5% of this 10K, which is $500. But now we're going to take this and divide it between all these stocks. Well, guess what? The actual dollar amount for your stop loss is going to be the same. And you say, wait, I'm lost. How do you do that? Well, let's just do the math. Because you only have 25 of each stock, if you have 25 stock and you lose $5, that means that your total loss will be $125 for stock A. You have 25, you lose $5. You lost a total of $125 for all the stocks. And if these are all the same price, that means that each one loses $125, and there's 4 of them, which is, what's 4 times 125? 500. So you see that you actually don't have to change the dollar amount of the stop loss when you add more stocks to your portfolio. The difference, okay, here's the main difference, all right? I'll leave that up just so you can look at it. The difference is, and this is very crucial, in this scenario, when stock A takes off and makes, let's say, $10, you're going to make $10 times 50, you're going to make 500 bucks. In this scenario, when stock A, these are the same stocks, stock A and stock A. When this takes off, you've only got 25 of them. So when it makes 10 bucks, you only make $250. So by adding more stocks to your portfolio, you are also limiting your reward, okay? Your risk is the same. You have the same exact amount of risk with this scenario as you do with this one, but this one you have a greater chance of reward when the stocks go up than you do with this one, okay? So again, this kind of illustrates too how diversifying isn't always the greatest thing. I typically would always like to have more than 2 stocks when I'm trading. Usually, I like to have 4 or 5, but I don't like to have too many more than 4 or 5 or 6, and I don't like to have anything less than that. I'll make a different video about why that's the case, but just look at how this works, that even though your risk is the same, and your dollar amounts for your stop loss are the same, you're going to benefit more from a movement in company A and B than you would in this scenario, even though you have the same exact stock, but you have less than what you do here. Okay, now let's give this a little bit of a twist and look at scenario C. Okay, this is scenario C. Same amount, 10K, but what we're going to do is we are going to actually invest less of our account. We're not going to invest the full 10K, but what that is going to allow us to do is we're going to have a much wider stop loss, and so our stock can go up and down a lot more, and it's going to be the same amount of risk. So let's look at how we do this. We're going to invest again in stock A, but this time we're only going to buy 2.5K of stock A and 2.5K of stock B, okay? So now what we've done is we're replicating this over here, but we're not going to buy anything else. So if you use your brain, you'll see we've only invested 5K of our total money. So the other money is just sitting in cash. But we're okay with that. We have a strategy. We only have 5K total, okay? Which means that at $100, it's just like this. We bought 25 here and 25 here. Now here's the difference. We always are willing to lose 5% or $500, but because we have less capital invested, we can have bigger stop losses, okay? Because if we divide this $500 by 2, each trade we're allowed to lose $250. And the question is, if I can lose $250 and I have 25 stock, how much can I lose for each stock? Your answer should be $10, okay? Because 10 times a $10 loss times 25 stock is 250 bucks. So now I can go to the broker and say, I'm willing to lose $10 off of 100. So the stock is 100, but I can lose 10 bucks, which means that I can actually set my stop loss now at 90. Remember over here we had to go at 95 because that's the most we could lose. But because we're not investing so much of our money in the market, we can take bigger dips or bigger ranges in our stock and have wider stop losses. So now now we're down to 90 bucks, okay? And it's the same. If it really goes down to that area and sells, I will lose $10 of stock. There's 25, I'll lose $250. I can do that for each of these, and it's the same risk. All three of these have the same risk. But the advantages of each one, you can see now what the advantages are of doing these. On example A, you have a tighter stop loss, meaning you're more likely to get kicked out if the market moves down like 5%. You'll get kicked out and you'll lose that money. But if the stock market takes off, you'll benefit from having larger positions. You have bigger positions, meaning you have more stock of 50 in each one. In this scenario, you're spread out a little bit, and you have the same thing. If the market goes down like 10%, you'll get kicked out of all of this. But the advantage you have here is you just have more stocks. So you have more options of what can go right and what can go wrong. So this is, I guess, sort of diversifying, but really you're just increasing your options. You're increasing things that could go in your favor. And this is a bigger position. This is using less capital, so you're going to be able to be rewarded less, but you're going to have a greater range of possibilities of being able to stay in. This gives you the power to stay in the game longer and through greater periods of ups and downs, okay? So, yeah, same $500 loss. So you can look at the three of these and kind of figure for yourself, what do you like best? And you can mix all these up. You could have 3 stocks. You could have 6. You could have even bigger risk if you want to for this portfolio. You could just tweak this as much as you want. But this is how risk basically plays out when you're looking at it according to your portfolio. You should always be thinking of the big picture. All the money that you have, your entire capital, how much of it are you willing to risk at any one time? And you can just tweak this and do all kinds of different stock positions and stop losses, but you're always going to want to follow your rules. In my case, 5%. I'm always going to want to stick with that 5%, whether I have 2 stocks or 4 or 2 and with smaller positions. Okay? This, again, the biggest advantage here is when the stock does this number right here, okay, I'm not going to get kicked out. If this is $100 and this is like $92 and this is 110, it's going up and down, up and down. I'm not going to sell out unless I get down to 90. If this same scenario happens with these 2 options, then I'm going to get kicked out and lose my entire 500. So, however, when this goes way up, I'm only going to benefit from the size of 50 stocks, okay? When it happens over here, I'm going to benefit from the size of 100 stocks. So I have twice the movement. This is powerful for when the stock market goes my way, okay? This is powerful for giving me lots of different ways to go up from different areas. This is powerful because it allows me to stay in the longest and get the most sleep at night. So, different ways to think about it. I hope that helps, and we'll probably make a part 2 to this video to explain different things that you can do in addition to this. Thanks a lot.